Good afternoon or good after evening, good after evening or good evening if you're on the East Coast. I'm on the West Coast. It's still afternoon. My name is Jillian Sidoti. I'm with the Multifamily Investing Academy, and today is Webinar Wednesday. Thank you so much for attending today. For those of you that are on the line, I know we switched the time. We're trying to find the perfect time for our webinar attendees to see what they like the best. So instead of doing our usual 1 p.m., 4 p.m. webinar, today we're trying out a 4 p.m., 7 p.m. webinar. We'd like to hear your feedback on the time, what time you would like to see a webinar, what time's the best time for you to come to a webinar. And with that, let's talk about what today's subject is. Today's subject is, excuse me, my Skype keeps going off. I'm going to turn that off. Our webinar today is about identifying and managing risk with your multifamily business. Now, what does that really mean? Well, as we know, risk equals reward. So when you're looking at risk equals reward, what does that really mean? That means that the risk that is associated with your business should be closely tied to that of your reward. But what our special guest today is going to talk about is how to manage that risk so you minimize the risk but still get all the great rewards. So with that being said, and without further ado, let's get into what we're about at the Multifamily Investing Academy. We are a premier educational facility that focuses on not just how to get into multifamily investing, but we take your hand and show you exactly how to manage that property, how to look for a good property, what really to do in the multifamily business. But we know that it doesn't end there, because once you find a property and you know how to manage that property, you know how to acquire that property, you know how to dispose of that property, the big problem that I personally always see is how to finance that property. So we not only teach you how to get the property and what you need to look for in order to make a good deal, but we also teach you how to get the financing, whether it be private or public money. And so that's what we're really looking towards doing here at the Multifamily Investing Academy. My name is Jillian Sidoti. I'm going to be your host today. I am a securities attorney. I'm here on the West Coast in Southern California. I help real estate investors specifically put together the documents that they need in order to appropriately raise money for their real estate investment projects. Our special guest today is Kate Dobbins, who is the lovely wife of my partner, Charlie Dobbins. Kate is the proprietor of Business on Point. She has over 20 years in business analysis, management, and advisory experience. She helps businesses across the board help manage their business, grow, and really pinpoint the problems so that they can put their business on autopilot. I just can't believe some of the clients that Kate has helped and some of the clients she has. We work together on a project called 2-Day MBA, and her insight is just absolutely amazing. But beyond helping all these businesses, she also is an owner of multifamily businesses, multifamily units, along with her husband Charlie. Together they own over 440 units across the United States. And she's been married to Charlie for 20 years. I'm not sure how that's possible, but she is. And they have 4 wonderful children, one of whom is going off to college next year. Kate, are you there?
I am, Jillian.
Excellent. Can you speak? Oh, yep, I can hear you. If you could just speak a little louder into the phone, that would be great, because I just want to make sure everybody can hear you.
Can you hear me? Is this all right? Can you hear me now better?
Yep, a little louder. Just speak. Make sure you're always speaking right into that microphone or telephone, whatever you're doing. And with that, I want to give you the platform now to go ahead and present to us how to manage that risk in your multifamily business.
I'm sorry, Jillian. I was just taking myself off the headset. Can you ask that question again?
I'm just giving you the floor so you can go right ahead and get into how to manage the risk.
Great. Okay, well, thank you so much for coming tonight. This is a subject on risk management that is very near and dear to my heart because it is something that people get very nervous about in looking at multifamily investing. And as Jillian so aptly said at the beginning of our webinar this evening, is that risk is correlated to reward, and that is most definitely true in multifamily. We hear about measures in the industry such as the cap rate or interest rate or rate of return or internal rate of return, and these are all not exactly industry specific, but the cap rate certainly is. But they are measures that we look to as indicators of risk in this business. And you'll see here on this slide, this is just a standard off-the-shelf definition of risk, business risk or corporate risk, and it is the probability of loss inherent to an organization's operations and environment that may impair its ability to provide returns on investment. Now, if any of you were listening maybe a month or so ago, I hosted a webinar with this team as well, and we were just talking about the business of building a multifamily business, that in fact it is a startup business for most people, and looking at it through that lens. And really this is a continuation of that subject in my view, because although multifamily has its own risk measures like cap rate, like interest rates, like internal rate of return, it is really one of the only measures, it measures only one of the risk factors, and that is really the industry risk. But there are a multitude of additional risks that are present in these deals and in starting a multifamily business. And the objective of Multifamily Investment Academy is to really equip investors to understand what it is you're walking into. The opportunity, the objective here tonight is to create an understanding beyond just the risk that is inherent in real estate, beyond just the cap rate discussion or the interest rate discussion or the IRR discussion that you would have with your investors. This is a broader discussion surrounding the multitude of risks that are present really in any business that's in business. I also want you folks to listen from a point of view of where you are coming from, because clearly one of the risks that is associated with any business enterprise is what your experience, what your personal experience is, how you are relating to the opportunities that are in front of you. So I want you to try to adapt this webinar this evening as much as possible to your own personal experience to date. Now, this is a slide that I used a few weeks ago, is that multifamily is presenting a time of great opportunity in the marketplace right now. I showed this a few weeks ago. I thought it was worth coming back and looking at it again. We are at a great point in the cycle, the economic cycle of multifamily. You can see we're at the bottom of the trough. This sector performed extremely well last year, exceeding industry analyst expectations. There's a lot of froth. It's an industry, a finance term. There's a lot of froth in the marketplace right now, or it's starting to get frothy again. Cap rates are coming down. There's a steady amount of competition coming in. Real estate investment trusts are very hungry and out buying products very quickly. There is a shortage of high-quality transactions, investment opportunities that are lower in risk, and so that's what's driving the REITs and their activity. So I wanted to start us off by seeing again here something that we all know to be true, which is that we are at a time of great opportunity, and that's a very exciting thing. And in the best way to deal with risk as you're evaluating an opportunity, like what's going on in the multifamily space right now, is to understand where the risk is located. And as in any business, and that's the point of this discussion, is that we've got risk that is external to the business, we've got risks that are internal to the operations of the business, and then there are the mysterious, intangible, or unknown risks, and we'll talk a little bit about that as well. this evening. So the first topic I wanted to jump in on here is understanding and discussing the external risks. And these would be categorized as the risks that are outside of your direct control as an investor. These would pertain first to the overall understanding of the industry and the rhythms, the undulations, the cycling of the industry and how it relates to the overall general economy. Multifamily has gone through a really tumultuous time in the last 3 years since the collapse of the economy in 2008. Not one analyst expected multifamily to fall as far as it did in 2009 with occupancy, or for the decline in availability of capital to collapse construction and the pipeline the way it did, of the pipeline of new product. And it's very important as a prospective investor to make sure you have that 30,000-foot view of how this chosen industry of yours is playing out relative to the overall economic health and how it behaves relative to economic cycles. That is your most macroeconomic view, and if you don't understand that relationship, that is a risk, is where are we in the market cycles. Like I've said here, the general economy, as the economy declined and jobs declined, our unemployment rose, people's ability to actually afford apartments declined. There was an exodus out of apartments that happened because people couldn't pay their rent. It is a direct correlating factor. Is if people are employed, they have jobs, they can pay their rent. If they don't, they move out or they consolidate with a friend. All of a sudden 2 or 3 people are living in an apartment instead of just one, or people are leaving and going and living, they're moving in with friends and family. And that caused a spike in occupancy. I'm sorry, a spike in vacancy in 2009. And the depth of the unemployment portion of this recession has been far greater than analysts expect. We all understand that. So the impact on this segment of the economy, the multifamily segment, in the short term for a couple of years, it really hit home. Now, we've bounced pretty quickly in this industry, principally as a result of the foreclosure crisis. It's driven a lot of people out of their principal homes and has created demand back in the rental marketplace. So that has balanced out some of the supply and demand gaps that had happened in the prior year. So there's been a balancing out of the supply and demand, and that's been very good for multifamily. And occupancy is up, rents are up, overall demand. The other indicator here in the industry that's a very important item for us to be evaluating and is a risk factor is capital access. This is an issue that really hit us in 2008. It's still present in the marketplace today. This is a risk to all of our continued success in acquiring multifamily properties. Obviously, we need capital to do that. So understanding what the appetite is for financial institutions to support any kind of transaction that you may bring to the table is an important element, and it will help set you up. Jillian had indicated at the top of this call that one of the important roles that the Multifamily Investment Academy wants to play for its clients is advisory work on putting together the financing, and not just helping source the debt with the mortgage brokers, but really helping clients understand who they need to be on paper, what the experience is, and what will make a bank get to yes. So that is a risk. There is understanding how you access capital to support the transactions.
Can I just interrupt you for a second? I just want to say something about the capital access portion of what you're saying, because what I want people on the call to understand is that although capital access in terms of bank financing has become extremely tight and almost impossible to get, it is my experience that capital access to private money or even just public investors who want to get into real estate but can't do it on their own is abundant. Folks don't want to invest in the stock market anymore. They're scared of it. After February 2008, where so many people lost so much money, and the stock market lost money on mutual funds, and are realizing that they're not going to get those gains back the same way that you can get in real estate, they're looking for alternatives. This being, the multifamily market being one of those alternatives. And personally, I'm seeing more and more little funds pop up that are being very successful in getting the private money. Maybe not so much the bank financing, like I said, but they are successful in getting the financing in terms of private money. And if you can bring those ratios down, from 80% loan to value to maybe like 65% loan to value, you will find that you will be able to get both the bank financing and the private money.
That's exactly right, and I don't want to leave people on the call hanging and identifying, just go through a laundry list and category after category here of what the risks are. I think it's very important that we identify them and help, lay out the prospective, potholes that could inhibit your success as an investor, but also lay out the strategies. And one of the key strategies that Jillian just talked about is making sure you've got your private capital lined up. That helps you feel like you're a loaded gun when you're out in the marketplace, which is a very important feeling of confidence, and it's an expression of confidence to the brokers and to the sellers. But the other thing is deleveraging the transaction and bringing it down in line with where the market is expecting transactions to be now. There is capital. It's on the sidelines. Banks are starting to stick their toe in the water. Some of them are actually really diving in, but there is a strict adherence to leverage. Leverage levels are down from where they were 3 years ago when the market was at its peak in 2007. And that, some people perceive that as a negative. I don't personally. I am an owner-operator of property, and I know the effect of high leverage on the operations of a business, and we'll get to that a little bit later. But one of the things that, as part of my professional experience, is that I've been a commercial lender for 10 years when I first got out of graduate school, and it's one of the best ways to mitigate risk in any kind of business is to not over-leverage it and not over-stress the operations by having to hit a huge financial nut every month. So that's an important discussion, and I'll be interested to hear if we've got questions on this particular issue at the end. One of the other important elements here is the competitive forces, and on the screen I have that right now. The competitive forces that I'm talking about are within the industry themselves, and really the reference here is who's your competition when you're out looking to acquire. And right now, for A and B quality or type of properties, you're going to have a lot of competition from the REITs. They've got a lot of capital, they're hungry, and they can move very quickly and decisively. And I have spoken to clients who find that to be discouraging, and my feeling is it's a big world out there, and their confidence in the marketplace is a show of strength, and that's the good news. And the other good news is there are a lot of creative ways to do deals, and working with people that are experienced, like Jillian and the folks at Multifamily Investing Academy, there are some alternative techniques for acquisition that really do work, and they're not the techniques that REITs use. REITs go out and they're like vacuum cleaners in the landscape sometimes. So we can talk more about that. And our next slide here, we're going to keep talking about the external risks. If I can get it to advance, there we go. And this one really pertains to the market risk. So the industry risk is at the highest level. That's that 30,000-foot view. The market risk is really specific to the market that you're choosing to invest in. And that, let's take Chicago just as an example. So what we're talking about here is, is what's going on in Chicago. What are the various submarkets? What are the rules of the game in Chicago? What are the tenant rights laws like? How tough is it to be a landlord out in the Chicago marketplace? What's the regional economy doing in that marketplace? Is it growing? Is it stagnating? Is it concentrated in one industry? Those would be the regional economic risks that I would recommend you pay very close attention to, because if you have a cataclysmic event within a certain market, it can really kill the jobs, which then secondarily sends a shockwave through the multifamily and landscape within that marketplace and can really hurt you. So those are the kinds of risks within that specific landscape that make that can really make an impact on your business. Charlotte, North Carolina is a very good example because when the banking crisis hit, there were massive banking institutions that were headquartered there, and within a period of 6 months, hundreds of thousands of jobs were lost. And who knew? For the years prior to the economic crash, Charlotte was identified as an emerging market, a great place to be, and relatively bulletproof. But it was so concentrated in banking that it was riskier than people wanted to admit. And I think people can put on rose-colored glasses, particularly when the market is starting to peak or is peaking like it was in 2007. Okay, another issue. We're going to keep coming back to this. You know, we're going to talk about risks at the macro level, at the micro level, and then I'll say at the micro level, really at the ground level. But here we're looking at demand. What is going on with demand, supply and demand of housing within a specific marketplace? Some markets are greatly affected by the shadow market of foreclosed single-family homes. Some are not. It depends upon what's going on with the preferences of the people that live there, what's going on with public assistance, and this can be very specific to a local market. It can actually be very specific by submarket and by neighborhood. So you're going to get the message from me over and over again tonight, which is to make sure you're understanding the factors that are going to affect your prospective investment at the very specific local level. You know, there's that old saying about real estate that it's location, 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 and that's very true of multifamily as well. Where your property is located and what is going on within the micro market, within the 1 mile and the 3 mile and the 5 mile radius around that property is very relevant to the risk profile and how you need to look at acquiring and structuring and operating that transaction. Looking at competition in your market is an important element. We're getting really into operational issues here, but knowing who the customers are, how they shop for apartments, what their housing options are, and then who else is providing what your actually the competing apartment communities are offering as far as amenities. There's an interesting tidbit here, which is our property in Kentucky, which is actually 2 multifamily properties. They're built at different times, but we've acquired them as a single property now and run them as a single property. One side of the property was built a little bit earlier than the other side, and it actually has these beautiful balconies, or balconies on the second floor, and patios, walkout patios on the first floor. And the residents love that. They love that amenity, and we don't have a problem essentially selling or occupying that part of the property. And last year we were doing a significant lease up on the property, and we're realizing that we're having a really hard time leasing our units that did not have patios or balconies. And it makes sense because this is in it's in Kentucky, so it's a southern climate. It's not deep south, but the culture in that community is to be outdoors in the evening, to be outside with your community, essentially hanging out outside. And that is very much the lifestyle in Kentucky. And in looking at that as a physical amenity for that property, we've actually had to price the units that do not have balconies or patios at a lower price point because they are less appealing. And that's something that's a very specific cultural habit to that part of the country, that people really take it into account when they are deciding to rent. Those are the kinds of specific details that are important for you to know as you are understanding a property acquisition. Perception of the property is also very important. What side of town are you on? What type of property? Who lives there? For some people, you know, if it's a Section 8 property, they wouldn't touch it. They would never go and live there. For other people, because they are Section 8 prospective residents, it doesn't bother them. But really understanding what the community sees when they see this property is important. Don't just look at it through your eyes. Make sure that you're seeing it through the eyes of your prospective residents and the members of the community, because they know things about that property that you may not know, and that's invaluable intelligence. Okay, I call this category of risks as crossing the chasm. And this is where we go from bridging from external risks, things that are really outside of your control, but you still need to understand and relate to your business and multifamily investing, to really getting inside the business. And this is the process of acquisition. And acquisition is there's a lot of focus on this step of multifamily investing, is doing the acquisition and looking at deals and putting out offers and all of that. And there's a lot of training associated with that, which is excellent. But you really need to get this step right and manage, knowing where the risks are. And if you don't manage these risks well, they become legacies into the operation stage of the business that are very difficult to undo or offset. And some issues you can manage through or correct, but these are very difficult ones. So I've highlighted these. I'm not trying to be the bearer of bad news. I'm just trying to be the bearer of information here. So in looking at acquisition-related risk, I really see it as there are 4 categories. There's the actual transaction structure. How are you financing this? What are the terms of the financing? What's the price that you paid? What are all of the contingencies that might be built in to protect you, that are favorable for you or not favorable for you? And I'm speaking in broad brush terms because I know Jillian and Charlie have spoken about acquisition strategies, financing strategies, and they have spent a fair amount of time on this. If you've got specific questions, we can take them at the end. But I wanted to highlight, again, the risk issues that are present here. So that is the transaction structure, and negotiating a good deal is very important. Conducting very thorough due diligence is a critical area. Much of the due diligence is driven by the bank, and many early-stage investors allow the process of due diligence to be almost exclusively driven by the bank because they don't know any better. They've never been through the process before. They think, well, hey, the bank is trying to lend us a couple $1 million or several $1 million, and they're going to do it right, and they're going to get the engineering studies, and I'm just going to follow their lead. And it's good to watch what the bank is doing, absolutely, but it's extremely important that you as the buyer kick the tires yourself and know how to conduct proper due diligence on the financials and the cash flow and the leases that you're buying, and also on the physical property itself.
Well, Kate, can I say something to that end? Because,
absolutely.
You know, the big thing about that is, like, I almost feel like this number 3 is the most important. Because,
yeah,
like it says at the bottom of the slide, very difficult to undo or offset. Exactly. And I can't, if the audience will just indulge me for a second, I'll tell a quick story. I had a client who didn't do the proper due diligence on a property. And he ended up purchasing the property just on the basis of the financial statements that were provided by the previous owner and by the underwriting that the bank did. And in the end, he ended up going down to the property after he already purchased it and couldn't figure out why they couldn't bring the rental levels up to where they needed to be in order for the property to be profitable. And it turned out he couldn't do that because there had been 2 rapes and a murder on the property, making it a very bad place to live. It had a reputation around town, like nobody wanted to live there, period. So as try as he might, he tried and tried and tried, and what he did was he put, you know, security in there, put 24-hour security, spent a lot of money trying to bring up the reputation of the property, which it helped a little bit, but it was almost a little too late. I was never able to really bring that property up to where it needed to be. He just saw low rent levels and thought, I can reposition this property, I can do it. But those 2 things, had he found out that all that crime was, that serious crime, not just crime, but very serious crime had been taking place on that property beforehand, he would have been able, A, to negotiate a better deal or known better and not purchase the property. And because he didn't know those things and didn't do the proper due diligence, in the end, he ended up losing the property because it was just too much. The expenses were too much to maintain, and the cash flow just wasn't there. So this part, I cannot explain enough how important that is to do. And not, our webinars are not sales pitches. Our webinars are purely educational. But almost as a sales pitch for the Multifamily Investing Academy, this is the stuff that my partner Charlie helps you with identifying. What are these risks? What are these acquisition-related risks that you can avoid, or you can at least be aware of when purchasing a property? And that's why it's so important to have somebody as, for lack of a better term, a mentor, a professor like Charlie to help you out to realize these things. So, Kate,
right.
Please take it away.
No, I think it's, and it goes to, what you were just talking about with that experience, Jillian. Unfortunately, I have heard that from investors. I have heard that same story, I don't know how many times, probably 4 or 5. I can name 4 or 5 specific stories that are just like that from people that thought they were doing it right, and it's a heartbreak. And when you have due diligence that's misleading, and then you walk into an economic storm the way we have over the last couple of years, it stresses the operation so terribly that the ability to absorb and work through risk is really limited, and so you get cornered very, very quickly. And that's a very unfortunate thing. And those issues are very much avoidable. And working with people that know how, that have walked the road and can offer advice is one of the remedies for sure. And what you said specifically about violent crime happening on properties or drug activity on properties, these things can be found out, but they're not going to be offered up by the seller. They're not going to be offered up by the bank. Is not necessarily going to know them. These goes to the issues of perception and how the property is viewed within the community. And it can be very difficult to turn that ship if a property has a long-standing reputation in the community that's negative. And particularly when you're coming in from out of town, it's easy to get blindsided with that because you don't have the intuitive market understanding and say, oh, that's a tough neighborhood. And we all know what that's like in our hometown, but we don't have those antenna up the same way in a market where we don't live or we don't have a lot of experience. So that point cannot be
that's so true.
Emphasized enough.
So true. And the thing is, like, we used to do commercial development at my old company in San Diego, and I didn't understand when I first got here. I came out here from Boston. I didn't understand the San Diego market, and my boss explained to me, who happened to be the CEO of the company, he explained whenever I would try to bring him a deal that you need to know exactly where that property is in San Diego. And I said, well, it's in this general area where we buy properties. It should be a good deal. And he would say to me, no, because in that particular area of town, you can move one block and it will make all the difference in the world. And it was so true. There was literally there's a triangle of highways in this one area of San Diego. And if you go just a little east of the triangle, you're in a bad neighborhood. But then if you go a little east further, like 2 more blocks, you're back in a good neighborhood. But if you go over one highway, you're in the middle and you're in a good neighborhood. But then if you go over the other highway, you're in a bad neighborhood. But then if you move even further, you're in the best neighborhood. So it was just this incredible, you had to really go down and see where the property was, understand the neighborhood it was in, because the neighborhood literally could change by crossing the street. It matters
exactly
what side of the street you were on. And so, yeah, these acquisition-related risks are so incredibly important. Kate, we are 30 minutes into this, and I do want to make sure we have some time for questions, so let's move on. I'm sorry to keep interrupting.
That's all right. So just to make 2 more points here, the financial model, if you haven't done your due diligence correctly or thoroughly, it's going to be reflected in your financial model and your business assumptions. And you'll be making your decisions and offering a property for investment to people based upon incomplete information, and that's when your poor due diligence translates into a poor financial rendering or a set of projections. The final point here on this slide certainly is making sure that you understand exactly what you're getting into from a legal perspective, and you understand your outs and what your exposure is, and how you can optimize your legal protection. Let's keep moving. As Jillian said, we've got a bit more to get through here. So we looked at this slide, and this really goes to what is your risk tolerance and what are your resources. And this is a good slide to sit back and say, what type of property do I want to be looking at? A, B, C, or D. My personal experience has been, and my recommendation to investors is that you make sure you're matching your own risk tolerance to the property type. And that is not just, gee, I'm feeling like I can tackle the world. It's also being very realistic about your capacity to bring in cash if a property is struggling, the amount of time you have to commit to a property, and having a really sober estimate of what it's like to own and operate or own and oversee management of an A versus a B versus a C property. Okay, so all right, moving into the internal risks, and these are the risks that are relevant to the operation of any business. And I'm going to keep beating this drum whenever I come and guest speak at the Multifamily Investing Academy. When you're investing or starting this business, you are creating a startup enterprise, and so you have business startup related risks. They can go to what is your level of knowledge. Imagine somebody that's just starting any business. And there's always a level of startup-related risk. What is your level of knowledge? What is your level of experience in the industry, within the market that we've talked about in doing these kinds of transactions? And then, of course, what is your business management experience? A classic investor in multifamily is somebody who's been successful in their day job. They have a level of maturity to them, but very often they've been working for a larger corporation, maybe the government, and they have never actually built a business from scratch, from the ground up, and they don't realize that that's what is involved here. And so they're thinking, well, I'm just going to take money out of my retirement, and I'm going to invest it in multifamily the way I would in a mutual fund, and it's going to be passive. That is a misconception, and that is a huge risk to that retirement fund that you've spent years building, and I wouldn't want you to be blindsided by that risk. So there is a real multiplying effect here. So if you are inexperienced in the industry, and then you compound that by being inexperienced or inexperienced in a particular market, meaning you're going to invest halfway across the country in a place that you've never lived, you're inexperienced in these forms of transactions, and you're inexperienced in business management. I can just feel my own kind of chest tightening as I layer one level of risk on top of the other. But the way to unwind that is, in fact, to limit the industry risk, become extremely knowledgeable, limit the market risk, which is stay closer to home, limit the transaction risk. Don't go into a super complicated or a super large transaction. And then go into business management slowly. Start small and work up, or work with, maybe invest passively with somebody else. Watch them and apprentice with them before you try to drive the bus on your own. So just some things to consider. When you are managing a business, this is risk number 5, which is you have to make sure that you are producing a product. These things do not happen on their own. Do you understand what it takes to actually turn an apartment unit into create new product? When somebody moves out, they trash a unit. Do you know what it takes to actually put that unit back together, hire a crew, get it ready to sell? Meaning I'm not talking about selling the apartment. I'm talking about selling your product like you would in any business, which in apartments is getting your apartment ready to be marketed out in the landscape of available housing units. How do you source the materials that are needed to do your turns? How do you build relationships with vendors? How do you manage the process and the staff? So there's a production aspect to this that people, again, very often do not even consider. How does all of that get done, and what is involved with that? This goes to the concept of having a management company take over all of these issues. Some people might be thinking on this call, well, why don't I just have a management company do that? And you may choose that as a as a strategy for yourself. But it's very important that you as an owner that is overseeing the management company understand what they are responsible for so you can hold them accountable for good quality work. You can't blindly manage a management company and do it successfully. They will take advantage of you, and they will typically not do a good job, and it will cost you a lot of money. So being knowledgeable is essential. Another internal issue here where knowledge is important is understanding the sales process. How do you market and sell this product? What's the competition? How are you positioning your product in the marketplace? This sounds, I'm sure it sounds to you all like classic business 101 issues, but that's the point. Is there's an element of business management here that is actually the sales process. And you've got to create the product, you've got to sell the product, and then the next slide is about dealing with your finances and collecting the cash. There are three very different areas of business management, and without an understanding of the fact that these are all part of this business and an ability to deal with them, managing them yourself or managing them through somebody else, you would be unaware of the realities of this business. Moving forward, I'm going to move go ahead.
Real quick, before you go to that next slide, how do you handle, or maybe you've never had this issue, but how do you handle negative reviews on websites of your particular apartment building? Like, I know some people who are listening here today have seen an apartment building that, because it was discussed amongst many different people, that was rated 11%. Like, in other words, it had a failing grade as a place to live. How do you handle that with your rents, with your sales, with convincing people, hey, this is an okay place to live?
That's a very good question, and it's very common in this business. Unless you're living in an A-plus quality building, those review sites are loaded with criticism. And if you just think about who is the person who's going to be motivated to sit down, log into one of those apartment rating websites and say something, those are going to be the people that are angry. People that are happy don't go out and express their happiness on an impulse, through apartmentratings.com. It's people that are ticked. I'm sorry to be so colloquial, but it's people that are angry and they want to get back at you for something. So there are ways for the owners or the managers to respond and to address things on those sites. But it's also very important to make sure that if people are complaining, that you're listening to it and you're addressing it in your business. If maintenance is not getting done, then you've got to deal with that. If the property is, it's got bed bugs or cockroaches or whatever, you've got to address that. And you've got to make sure that your staff is friendly, that they take care of people, and that you are doing an excellent job. So if people call in and have an experience, then it's a positive one. There is marketing that can be done, particularly through like a refer a friend program with your property, where residents that are happy will actually, be great recruiters, and they give live testimonials because they say, I love living here, come and be my neighbor. And that's incredibly powerful kind of counterbalance to, a nasty review. But, as part of your due diligence, you should be absolutely reading every review that's on those websites. And if they're saying things like there's code violations or flooding problems or chronic plumbing problems, they might be fabrications, but they very well may not be. And it's a great way to actually get some good intelligence from people that are angry that you wouldn't otherwise find out. So use it for what it's worth, and it can be very valuable in due diligence.
Kate, let's move to your last couple of risks here, because it's 15 minutes till the hour, and we've got to take some of these great questions that people are asking. So what's our next one?
I don't want to leave you folks without going through, quickly our risk mitigators. Really, one of the greatest offsets to risk is making sure you do your homework. You research and read everything you can on the industry, on your market. Make sure you are collecting and mapping out your own data. Every deal you look at, you should be keeping track of and creating your own database of information. With my clients, I have a template that I created and I've given to all of my clients that is essentially a market tracking template, and we track properties that we're reviewing by submarket, And we probably have maybe a dozen key pieces of information. So as every deal is coming in, we're looking at them side by side by side. Which again, so it's not all, you're not getting it from all of these kind of marketing-driven sources that you're creating a lot of your own intelligence. If anybody on the call is interested in getting that template, I'd be glad to share it. So we can do that at the end. Obviously, one of the best risk mitigating strategies is to keep it simple and to know where your strengths are and where you're starting from. Start smaller, start closer to home, invest with someone else, and watch. Building a great team of advisors, people that are looking out for your interests, that have experience, that have done this over and over again. Mastermind with people who have done that. Keep coming to webinars like this. Prepare, 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 and then execute. This is just a slide that was from my last presentation about, you start with a vision, you do your data gathering, you plan, you execute, you get your lessons learned, you get better at it, you apply your experience, and you grow, and then you expand your vision, and you keep cycling it over and growing, slowly is the important message here. One of the worst things about risk is that it can scare you and intimidate you, and it should not. Risk is present in every business. And the seventh risk here that I wanted to highlight is the risk of doing nothing and having paralysis analysis. And I can really relate to this because I'm an analytical person by nature. So you need to figure out your tolerance, understand who you are, and then design an action plan that makes sense for you, and then take action. Don't let the risk keep you from taking action, but take action at a level that makes sense. This is one of my favorite quotes. Warren Buffett, all of you, of course, know who Warren Buffett is. He's just this amazing investor, and he talks about business is like baseball. Most games are won with base hits and not home runs, and I think that's an analogy I really like to think about personally, and I use frequently in my advisory of any type of business, is that rapid growth is very risky. The opportunities in multifamily right now are exciting. This is a great time. This time is not going to disappear in 6 months. We're in a slow recovery process. I think there are going to be opportunities, really good opportunities in multifamily for a number of years. So take your time, get ready, and execute in a very smart way. So the market will wait for you right now. So that's to the extent of my slides. So we can take our questions. I know, Jillian, you said we've got a number of questions that have lined up, and I want to make sure we attend to them.
Yes, thank you. Great presentation. Thank you so much. First, before I go into our questions, I do have I have a whole bunch of questions here, so we're just going to consolidate them into one, asking us about our next event. And if you don't already know, our next event is July 22nd, 23rd, and 24th in San Diego. It's a 3-day event. Let me explain how it works real quick. The first day we go to
Jillian,
yeah.
I'm sorry, let me interrupt you because I'm getting some background noise from your office, I think.
I think it's gone now. It just walked out the room.
Hard to hear you. Yeah.
Literally, sorry. What I was going to say is our next event is January 22nd, 23rd, and 24th in San Diego. The first day we go visit a multifamily property. Charlie will take you through, along with the broker, on what to look for in that property, what you should be searching out, how to come to a conclusion on what you might want to offer on that property, if you want to make an offer on that property, analyzing the deal. Then we go back to the classroom on the second day, and Charlie goes through the whole process of potentially acquiring that property and what you would need to do to prepare to acquire that property, as well as manage that property, rent out that property, reposition that property if need be, and disposition of that property. And then on the third day, I will show you everything you need to know on how to finance that property. Again, it's July 22nd, 23rd, and 24th in San Diego. And you can go to our website, multifamilyinvestingacademy.com, to find out more. You just click the button at the top that says 3-day intensive. That is our 3-day intensive course. A lot of you were asking us also about our old webinars. Our old webinars are not available on the web right now because we are currently deploying a new membership website. It's a fraternal organization. It's not just about getting, it's also about giving and interacting with your fellow multifamily or potential multifamily investors. we are going to provide you with a whole lot at the Multifamily Investing Academy as part of your membership. We've not rolled it out yet. We are testing it because we want to make sure it's the best membership out there for our potential members. So right now we are testing that website, and when that is deployed, you will be able to download all of our old webinars on there. But right now, as it is, you have to come to them live. So if you want to come to our webinars, they are every Wednesday. Just check the emails, check LinkedIn, check our Facebook pages. We will tell you when they are. But they are always on Wednesdays. We are experimenting with the time. We would like your feedback back on what the best times are for the webinar. So for all your multifamily needs, please go to multifamilyinvestingacademy.com. Now let's get into some of those very important questions for Kate. And this one is from Eugene, and he's asking, he's basically making the statement that there's a lot of equity loss in property in this economy because of bad economic times. It doesn't matter if it's commercial or multifamily. So you really need equity to gain additional financing. How can you work around equity loss issues? I'm going to let Kate answer this, but before she does, I'm just going to say, don't go to the bank. You don't necessarily need equity to show that a property has great cash flow to private investors. You might need that for a traditional institution. Think outside the box. Don't always think that you have to go to a traditional institution to get the financing you need. I'm telling you right now, private money and also small public offerings are where it's at. That's where you're going to get the money that you need, and not necessarily from the banks. The banks are turning into a very small piece of the financing puzzle in this climate. So I hope that answers your question, Eugene, but I'm also going to defer to Kate real quick and see if she has anything to add to that.
I agree. You know, if I'm understanding the question correctly, it's that would be financing on an existing deal. So if you were acquiring something new and going after bank financing, you would go the conventional route of having you know, investor funding or private funding for the down payment portion, and then bank financing for, you know, probably 70, 75, maybe 80%. Some of the, you know, once the transaction is getting up over $3 million, the 80% loan to value is still available, or is back to being available. So in a new money deal, the equity piece is less relevant because it would be structured just as a conventional acquisition. My guess is that you're talking about an existing deal where the equity has been compromised because of the decline in the economy.
Right.
If Eugene, I haven't answered the question correctly, please email us another question and I'll follow up on it.
Excellent. Thanks, Kate. The next question is, interest rates are low. I can only see them rising in the near future. When interest rates rise, this will affect DCR, cash flow, et cetera. How would you protect against it? And just assume your loan will have a much higher interest rate than what they are now. So in other words, what do you do about rising interest rates, Kate? What about that risk?
Well, I don't, you know, there's a lot of speculation about pent-up inflation in the economy right now. However, our economy is not, you know, chugging along yet. It is still, we're still moving at a you know, very feeble pace, and so interest rates are still very low in this country and expected to remain low. If you know, read the journal or pay attention to what people are saying about you know, the monetary policy, interest rates are going to remain low for probably the remainder of this year and into at least the first quarter of next year, because they're trying to get capital and they're trying to get it out of the banks and get it to work. It's not until the pendulum starts to swing in the opposite direction that, you know, where there's too much capital out in the marketplace and that, you know, interest rates will rise to draw it back into the banks. Right now the banks are trying to get it out. So I think interest rates are going to remain low, and the thing to do is to get into longer term fixed rate transactions. The last acquisition we did, I purposefully structured it so that we would have 10-year financing on it. We had some options within the financing structure to re-leverage the deal so that we weren't just completely boxed in with no options within our financing structure, but we did get the protection of 10-year term money on a fixed rate, so we could mitigate against interest rate variations and how it would affect our operations. So there are ways to deal with that.
Thanks, Kate. I mean, gosh, you have so many great stories and examples. We're gonna have to do like some kind of special long webinar outside of the webinar Wednesdays, because I can tell you just like have all these great stories. You want to answer all these questions, and we still have a ton of questions. We only have 4 minutes, so I'm going to try to do the best we can to get through these. Okay, somebody's suggesting that you should buy in Memphis or Detroit. Those are emerging markets. There's nowhere to go but up. I'm going to respectfully disagree with Detroit. I do not believe that that is an appropriate marketplace in which to go right now. That city is actually shrinking.
If I can interrupt you,
Jillian,
if I can interrupt you, I'm from the Detroit area. I grew up there, and Detroit has, and I haven't lived there. I left there when I was 18. That was almost 30 years ago, and I would not invest in Detroit now. It is a dying city, and the population they've been losing population at a clip of 80 to 100,000 people every 12 to 15 months. I would not invest there. And Memphis, you've got to be very careful. I work with some people that live and know Memphis extremely well, and they wouldn't touch it with a 10-foot pole. There are some really challenging socioeconomic trends going on in that climate, and multifamily owners that I know that are owners there are really struggling with some of the issues that are there. They're easier places to invest, and those are very high-risk environments. I mean, Detroit for sure.
Yeah.
So, and Jillian, I know we're running slow. We're running low on time. My personal email, kate@businessonpoint.com, is up on the screen right now. Anybody that we don't get to, please forward your questions to me, and I'll either respond to you personally via email or I'll give you a call sometime in the next couple of days, and we'll just talk through your questions. I don't want anybody to be left in lurch.
Absolutely. So with that being said, if you need her template, because some people are asking about the template you were talking about, please just email Kate and she will send it to you. And then finally, I'm going to make this our last question. Sorry, guys. If you have any other questions, please email Kate. We've got exactly 2 minutes. What is the lowest occupancy you would ever consider buying a property? 40%, maybe higher? If I had, this particular person had a lead for a 35% occupancy building, but decided against it as it would be too painful to even make an offer on. What do you think, Kate?
It depends. If it were your first deal, I would say I wouldn't touch it with a 10-foot pole. If you know what you're doing, you're in this full-time, you have a crew, you know the market, and you buy it at an extremely low price, maybe. So that's my answer, maybe. If there are a lot of factors. Occupancy is not the only one. You have to look at the deal. You have to look at, there are just a multitude of factors, and I've highlighted so many different things that you'd have to consider. Personally, if you are a first-time investor, I wouldn't look at anything that's below probably 75% occupancy. Properties can tip over very quickly in occupancy, and you can have an absolute mass exodus on them. A 35% occupancy, that property's probably been in trouble for a while. You've got a lot of vacancies. Vacancies invite crime. They invite, squatters, drug dealing. You just don't know what you're gonna get, and the level. So, and the level of work. I mean, my guess would be is that if the property is struggling that badly, then there's a lot of deferred maintenance. The majority of those vacant units are probably in really tough shape. So you've got a very steep curve. So the price and what can you get out of it is a huge consideration. And you've got to be prepared for that kind of a beast, because that's a beast.
Thank you so much for that insight. So I hope that answers your question, Robert, about occupancy rates and what you should be looking for. Everybody else, thank you so much for coming to today's webinar. May I remind you to visit Multifamily Investing Academy and join us next Wednesday for another exciting free webinar where we only